We'll wrap up this off-grid telecommunications site series of videos by looking at the emissions and financial analysis tabs. First, what are the GHG emissions reductions? Let's look at the emissions page to determine that. The level 1 analysis is there. It's been done. We have 7.7 tons of CO2 emissions reductions per year. That's a fairly small amount. It's unlikely we'll be able to monetize those. That is, to get them audited in such a way that we could get someone to pay for them. Now for the financial analysis, let's make some assumptions. First, we mentioned that there's a 25-year planning horizon, so that'll be the lifetime of our project. Second, we'll assume 2.5% inflation. That will affect all future costs, including the cost for fuel, the cost for operation and maintenance, and the cost for equipment replacement. For simplicity, we're going to assume no debt financing, that this project is being done entirely out of, say, corporate savings. So pause the video, complete the Finance tab, and then unpause to see the solution. Is this a profitable project? And what is the simple payback and the equity payback? So those are two aspects of financial analysis that you might want to think about: profitability and quickness of return. Here on the Finance tab, I will adjust the inflation rate to 2.5% and the project life to 25 years. For the debt ratio, I'm going to set that to 0. So we end up with this cumulative cash flow graph, which is essentially the running sum of all the individual years' cash flows. And we can see that we start out by having to invest about $30,000, and then we have positive cash flow in year 6, but at year 10 we have to replace the battery, so this drops down, and that continues upwards until year 19. Of course, we have replacement of the inverter in year 13, as indicated here, and every 3 years we see a bit of a change here when we have to do replacement of the genset in the base case. So the financial viability here of 12.3% is not terrible. It might attract investors. It might lead to the project being done. However, the simple payback and the equity payback are both quite long. So the simple payback, as you might recall, is simply the initial cost of the project, so this $30,000, how long it would take to recoup that expenditure out of savings. So we can see that we take that, divide by the savings, minus that, and we end up with 11.8 years. It ignores many different factors. The equity payback does take into account other factors, and it's calculated by looking at where the cumulative cash flow graph crosses the 0 line here for the last time. So it says you finally achieved lasting positive cash flow at year 11 here. So we have two kind of different conclusions here. Yes, it's a profitable project, but the payback is very long. I want to show you one thing here though. We've been guessing at costs here, and if we were just out, say, by 10% in our estimates of the costs, so we go back to the cost page, and I'm just going to put in a line item here, cost correction, and we're going to put in a credit of $4,000. So that's essentially 10% of the cost of the proposed case power system. So this is simply to show what an error of 10% in our estimate of the initial costs of the proposed case power system would do on the finance page. So we turn to the finance page and we see our pre-tax IRR assets is obviously better, but it's not radically different. It's gone up about 2 percentage points. The simple payback has gone from 11.8 down to 10.2 years. It's also not radically different. The equity payback, on the other hand, has dropped to 5.6 years. Why? Because we're no longer crossing the 0 axis here. So this kind of shows some of the strengths and weaknesses of these 3 different metrics of financial viability. We have profitability being measured in the first one. And then we have quickness return, estimates of the quickness of return in the other one. So those would be of importance to organizations that are worried about tight cash flows. The simple payback is misleading because it ignores all sorts of factors like the replacement costs for equipment, or if we had financing here, financing impacts. So it has that downfall. The equity payback, on the other hand, it's a more accurate measure of how quickly the system returns cash to you, but it can change quite radically if you have a situation where you have a jagged cumulative cash flow graph. If we have a situation where the cash flow graph in one case crosses the zero line here, and then a slight adjustment leads it to not cross that line, you get a radical change. It went from about 11 years down to 5.6 years. So it's very sensitive in certain cases to the cash flows. So those are kind of the advantages and disadvantages of these three different things. Obviously, I would recommend that wherever possible, you look at the profitability of your project. But for certain organizations, the quickness of return is important. And in that case, you might look at both the simple payback and the equity payback. The equity payback is a more accurate measure that includes more considerations, but it can be sensitive to crossings of this zero line. In the next video, we're going to redo this project using Rhett's Green's Virtual Energy Analyzer.